Okay, I'll just start it now. Okay, welcome everyone to Bamboo Wealth Financial Planning Doesn't Matter YouTube channel. My name is Sam Tabit, your host. Today we have a special guest. We have Campbell Stevens from Van Dyke, who will be discussing with us fixed interest, also known as bonds. Before we start, I'd like to reiterate that the information we're providing today is for general advice, factual information. Now, of course, if you need to get personal advice, which is very specific to your particular circumstance, please contact us or visit our website and make an appointment, and we can discuss this further. But before I start, I just wanted to also mention that today we are living in extraordinary times, and the financial markets are sometimes behaving in ways that we don't expect, but hopefully we get some insights speaking to Campbell today. Campbell, thank you very much for being with us today. Welcome to Bamboo Wealth Financial Planning Doesn't Matter YouTube. I'd just like to ask you, maybe you can provide us some information about yourself and who you work for, what you do at Van Dyke.
Sure. So thanks so much for having me, Sam. I really appreciate it. So Van Eck, we're an investment management firm. We've been around since 1955. We've got about 60 billion in funds under management globally. We launched in Australia about 7 or 8 years ago. When I started at Van Eck about 3 years ago, we had $1 billion in funds under management. We're now almost at 5, which goes to show that ETFs is a growing segment of the market. I think there's a lot of reasons why it's growing. The fact that relatively cheap exposures to whatever you'd like. I mean, that's the great thing about ETFs is it really gives the consumer a choice in what they want to invest in, and opens up a whole range of markets, including fixed interest, which is far more accessible today than it was 10 years ago.
Okay, wonderful. Can you just explain to our listeners what is exactly a fixed interest market?
Yeah, sure. So fixed income or fixed interest, it's an investment security that pays a coupon until maturity, and then at maturity it pays principal investment. So really, from an investor's point of view, what does that mean? It's really about an agreement between two parties on a loan, for simplicity's sake. So there are some pretty main components to that, which is how much you're going to loan, which is the principal amount. How long are you going to loan that amount for, which is the duration, and how much will you pay me essentially for that loan, which is the interest. There's also the fact that are you going to pay me back, which is quite an important component of it, which is the creditworthiness of the issuer. So those are sort of the main components of fixed interest.
Okay, excellent. And what's the difference between fixed interest and cash?
Yeah, so as I mentioned before, fixed income, it's an investment security. Cash is what you need to buy that security. So, what happens when you hold assets other than cash is you begin to lose liquidity because those assets need to be sold to get cash, and cash is considered liquid because it can basically buy anything. So the reality is, one is a very, very liquid asset class. The other is quite liquid, but not necessarily as liquid, and you also lose the flexibility when moving away from cash into fixed income.
Sure. Now, obviously, there are some risks involved. What would you say would be a few main risks of investing in fixed interest market today?
Yeah, sure. So I think there's probably the 3 main risks that we look at are interest rate risks. So that's increase in the lending rates, which makes other bonds look more attractive over time if interest rates go up. The second one's probably creditworthiness, which, as I spoke to before, is what is the likelihood that you're going to get your principal amount back at the end of the maturity? And there are rating agencies that look into that, like S&P and Moody's, that give you a rating on each different bond. And then inflation. And inflation's the big one, and it's quite topical at the moment, I guess, given what's sort of been said by the Fed recently about possibly letting inflation run a little bit. You think about inflation as what your real return is. If your bond is yielding 5% and inflation's running at 6, then you're actually looking at a negative real return on that investment. So those are the three main risks that we sort of consider with fixed income.
Okay, wonderful. So just following on from that last example you gave with inflation, I understand it's about $17 trillion of negative yielding bonds. Can you explain to us how this happens in today's market?
Yeah, it's interesting. I mean, there's probably a couple of components to it. So, we look globally. You've got US yields on 10 years about 70 basis points. I think which 70 basis points is 7/10 of 1%. Aussie yield on the 10-year is about 1%. And then you go over to Europe, you've got Germany at about negative 40 basis points. So, on nominal terms, you're probably looking at negative, nominal terms, you're looking at negative returns in Europe or in Germany. And real returns, inflation adjusted, you're probably looking at negative returns. So, why do we have such low interest rates? Well, lower rates equals lower funding costs for individuals and companies. So what you're trying to do is stimulate demand. And that's in essence what, the RBA and the Fed are trying to do, and other global banks are trying to do, is stimulate demand, because we've been in this low inflation environment and we're trying to push ourselves out of it. Why is it happening is probably the more important question, which is, I think the reality is there's probably three main reasons to it, which is aging demographics, baby boomers, they're living longer, they're spending less, which equals reduced demand, which reduces inflation. And they're the second largest cohort after millennials. And I can tell you, as a millennial, we're doing our very best to increase inflation and spend lots of money. You've probably heard plenty about the smashed avocado on toast, but it doesn't seem to be working. So the central banks have to help us. But you can also think about it in relation to the way that your asset allocation is delivered for older clients versus younger clients. There's typically a risk off, and that's probably reason number one. I think reason number 2 and 3 tie in quite closely, which is globalization and technology, and that brings efficiencies to the supply side, which basically means that there's less inflation, because if you've got efficiencies on the supply side, then that's sort of economics 101, that supply demand intersection.
Sure.
So those are the three main reasons.
Yeah. So leading on to the aging population, a lot of retirees today are actually finding it quite difficult and are suffering from low return on their long-term life savings. Are there alternatives possible in the fixed interest market to compensate them?
Yeah, absolutely. And I think that's where financial planners, really play a big part in this, is, they can find, different styles of asset classes for their clients to sort of help alleviate the issues that they're seeing with regards to, the lack of interest on a big portion of their portfolios. We've got quite a few different ETFs that focus on that space. The one that I find quite interesting that, is a little bit spicy, but the reality of it is, you're going to have to move up the risk curve to get the interest repayments that you used to see and your portfolio used to be used to. And that space is emerging market bonds. You think about developed markets around the world, as I mentioned before, you've got real returns, probably negative for a lot of those 10-year rates. And emerging market bonds, have positive interest rates. I mean, we're talking, around 5% in China. So, there is that ability to start looking at alternatives, and ETFs give you, that access. And for us, EBND, which is our emerging market bond, has a target of 5% yield at this point in time. So,
sure.
I think there's there's ways to find value out there, and I think you've just got to look outside the box and maybe not just at government debt and or at least developed market government debt, but we also have a couple of other options: subordinated debt, corporate bonds. But yeah.
Sure. Yeah. Thanks for that. Now, what's your research view on interest rates? Let's say the next 2 to 5 years. You're looking at the long-term interest rate average, which is I've seen a research recently, sorry, which is about a negative. Interest rates have trended negatively for the last 800 years. So it's this is longitudinal study. What's your research view on interest rates, say next 2 years?
Yeah, I think look, the reality is your best bet is going off the rhetoric from the RBA governors and the equivalents, and the reality is Phil Lowe, who's the governor of the RBA, has basically come out and said this is it's going to be extraordinarily unlikely for us to go negative. The reality is, does he pull the trigger on a 15 basis point drop? So we go from 25 basis points where we're at now down to 10 basis points. Well, I don't think it's likely. I think we'll probably be here at around 25 basis points for at least the next 3 years. I think that's the idea, and it's really sit and wait. You have a look at the Fed. I mean, they're talking about trying to let inflation run. So the reality is there from that rhetoric that they're probably not going to raise interest rates as well until they start seeing inflation on a persistent basis. So, we'll probably be here in my view, we'll probably be here for at least 2 to 3 years as we allow the economy to recover. And then, depending on fiscal stimulus and demand side restraints, then we'll probably see an increase in interest rates over time.
Okay, excellent. Just one more question, Campbell. What, if you could inform our viewers, what book, could be investment or non-investment book, that has actually formed your or shaped your knowledge about investments or your financial literacy?
Yeah. So Rich Dad, Poor Dad, it's been a long time since I've read it, but the reality of it is it's more, I like the mentality of it, the psychology behind it. One of the quotes is around, the poor dad says, well, climb the corporate ladder. And that's the idea, is that you work hard, climb the corporate ladder, and eventually you win. But the rich dad, the entrepreneurial dad, goes out and says, well, why climb the ladder? Why not own it? And I really like that mentality. I think it's a paradigm shift on the way that people typically look at things, and I think it sort of says more about investing in yourself maybe than investing in the stock markets. But I think that's an important part of life as well.
That's a wonderful example, and by Robert Kiyosaki, of course, you're referring to. Look,
yes.
Thank you very much, Campbell, for coming in today and informing our guest about what is fixed interest. Hopefully, we can talk to you again in the future about maybe fixed interest again, or how trends have moved. But once again, thank you, our viewers, also for joining us today at Bamboo Wealth. Financial planning does matter. We have to hear from you, discuss another issue with you very soon. Thanks very much.